Welcome back to another Millennial in Debt video. Obviously, you have clicked this link because you want to know how to do investing properly during a recession. These tips are not hard, steadfast tips. They're just advice. Again, I always suggest to speak to a financial advisor before you play around with any of your money in the stock market game, because it's really not a game, right? So definitely speak to a financial advisor before you make any investment decisions. But these tips or advice are just to help guide you to do your own research and to look into companies that you might be interested in. So let's jump right into it. If you are not following on Instagram, you want to make sure you follow, hit that follow button down below, that link below, whatever, right? So you don't miss out on stock tip Tuesdays. Every Tuesday we'll be sharing information on Instagram about stocks. I posted this question right here and got so many different questions that I didn't want to make a million Insta stories or make a really long video. So I've broken it down week by week into different pieces of information. This week we're talking about how to invest during a recession, and next week and the following weeks we'll have a whole bunch of other information. So subscribe here on the channel so you don't miss a beat. Follow on Instagram so you don't miss a beat, and let's get right into it. So the first thing you want to do when you are investing during a recession is to create a watch list. I am probably one of the few people that use the stock market app on, is it stock market app? Whatever, the stock app on the iPhone, and I'll show you my screen here. My stock market app on my iPhone follows things, companies that I'm looking into. It also follows companies that I've already invested in because I like to see how they're doing, where they've been. You can also do it on apps like Robinhood, possibly Acorns. I'm not sure. I just use Robinhood and Acorns, and I'll link anything that I use below because they make it really simple. E-Trade, I also use E-Trade, and they do have a way for you to watch different stocks. It's a little more complicated than on Robinhood. So you definitely want to watch the stocks that you're interested in before you dive into them, which leads me directly into my second tip. There are 3 different types of stocks that most will recommend you to avoid during recession and to look into during an economic boom, and that's for many reasons. So the first type of stock that you want to avoid is highly leveraged stocks. Speculative stocks are the second, and the third stock are cyclical stocks. So what each, and I'll put the definitions around the screen, but essentially you're avoiding stocks that have a whole bunch of debt tied to the company, right? So their debt to profit ratio is very low or non-existent, right? Cyclical stocks are stocks that usually are luxuries that people aren't really buying during a recession, so the company doesn't tend to do as well as during an economic boom because people don't have as much money to spend on a luxury car or luxury bags and shoes. And then you have the speculative stocks, which haven't really stood the test of time, right? They haven't proven that they can last through a recession. They haven't really proven much of anything just yet. So it is not advised to invest in those 3 types of companies because they often do not do well during recessions. Okay. The third thing that you want to keep in mind when you are thinking about investing during a recession is you want to track or keep in mind your timeline. So what I mean by that is if you are a lot younger or much further away from retirement, you have more wiggle room in how you invest because you're not as close to needing that cash or needing that money as though if you were closer to retirement. So if you're 25, you're going to want to invest a lot more aggressively or play the market a lot more aggressively because you have the time for the stock market to rebound and go back to an economic boom, as opposed to if you're 62 and you're going to be retiring this year or next year, you don't really want to play around with that game because you don't know what the stock market could do. So you want to invest a lot more conservatively so you have access to more of your money when the time comes. So that's something to definitely keep in mind. All right, so the next tip that we're going to talk about is buying dividend stocks. I do have a video in store about what dividends are and like all that jazz. All right, so this is going to be a very brief overview. So dividends are really what the company that you've invested in pays you as a reward or as a thank you, essentially, for trusting in the company and putting your money in that company. Not all companies offer yearly dividends or regular dividends, and not all companies are offering high amounts of dividends. So you definitely want to look into, so there are so many sites that show you companies that have paid high dividends in the last 5 years, the last 10 years, the last 50 years, the last 100 years. So you definitely want to look into those companies because those are the companies that have stood the test of time, one, and have gone through many recessions and always bounced back and always have been able to pay their investors a dividend on an annual, biannual, whatever they choose to do. But those are really the stocks that you want to look into because they do kind of always keep it pushing when the economy's kind of in a slump. The next two tips go hand in hand, and that is when you're investing in consumer staples and utilities, right? So that's tip 4 and 5, I don't know, right? So sectors, there are 11 different sectors in the stock market. Again, not going to go into this video, but I will be talking about it on Instagram and YouTube at some point. I promise. Right? So there are 11 different sectors in the New York Stock Exchange, essentially, and pretty much all of the stock exchange. I'm going to focus on New York Stock Exchange because that's the big daddy of them all, right? And out of those 11, the two that most always 99.999% of the time do well or succeed or keep going or excel during a recession are the consumer products, consumer staple products, and utilities. And why is that? Because as we see during this pandemic, people are going bonkers for toilet paper. People are always going to need to wash their hair, so shampoo, food, because we gotta eat to survive, and clothing. People want to keep their lights on, right? People want gas, their water. So these are things that no matter if it's an economic boom or an economic crisis, people are going to need. They have to eat. So companies like Walmart, TJ Maxx, Ross, Con Ed, GE, they do really well, or they're insulated essentially from the recession because there are things that people need. So those are things that you want to think about when investing. Am I investing in a company that if people aren't shopping is going to crash? Or am I investing in a company that even when people are very, very limited with money, they're still going to have to buy these things? The next tip that I have for you is to invest in high yield returns on your money. I'm going to link this video up here for the high yield savings, okay? During a recession, the dollar goes far, 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 far less, which means you're going to need far more of it in order to live the same type of life you lived before the recession happened. So that means that your money needs to work for you. So you need to put it in high yield savings. You need to put it in a place that's going to yield a lot of return to you so that you have more access to money when jobs are being laid off, when interest rates are going crazy, all these things are happening. You know that your money is doing the best that it can do in the best location. And the last tip, and this has come to me in pretty much the last 2 or 3 years of investing and putting into my pension plan and all these other things, right? And that is you need to diversify your portfolio. So that means it's twofold. Do not go solely into stocks, right? Your portfolio, your investment portfolio should not be 100% stocks. That's a no-no. The second thing, I know a lot of times when we see companies like crashing or dropping or the price of their stock failing, we think, oh my God, if I own this stock, I need to sell it. No. Hold on to it. The stock market is indeed a roller coaster, ups and downs all the time. You really, really, really want to hold on to that stock and see what happens. So don't just sell the stock because you're seeing like, oh, it's dropped. Hold on to it. Wait and see what happens, right? And if you speak to the financial advisor and they say, you know what, I think we should consider selling this stock, that is something that you want to do. But don't let fear drive you, because that is where we kind of blur the lines of what is the best thing to do with our money and what fear is telling us to do with our money. So those are the things that you really want to think about when investing. I hope this video was really helpful for you. I hope it's given you some tips and advice on how to invest. And I hope it's reminded you that you need to get a financial advisor if you are thinking about looking more into the stock market. That's it. Bye.